Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 113 of Personal Finance for Long-Term Investors. My name is Jesse Kramer. By day, I work for a fiduciary wealth management firm helping clients all over the country. For more details, you can go to bestinterest.blog/work. Link is in the show notes. And by night, I write a blog called The Best Interest, and I podcast here on Personal Finance for Long-Term Investors. I help busy professionals and retirees avoid costly mistakes and grow their wealth by simplifying complex ideas about personal finance from investing to taxes to retirement and beyond. And today is another one of our popular AMA episodes with some incredible questions, including, do Social Security and a pension replace bonds in our retirement portfolios? Another question about long-term care insurance, what the cost-benefit analysis of that is. Some questions about taxation and distribution of inheritance assets, about RSUs, ISOs, other forms of equity compensation. A really good question about timing the market, especially now with the market at all-time highs. And a final question about the possible nasty interactions of RMDs, that's required minimum distributions, and the sequence of returns risk. But before we get into those questions, we have a review of the week from Brian8110, who wrote in and said, an informative podcast. I discovered this podcast a couple months ago, and it's become a must listen. Jesse shared an HSA strategy in his latest episode I'd never heard of before, saving receipts but letting the money grow tax-free instead of withdrawing it immediately. It's impressive how Jesse can break down these complex topics into a very clear and easy to understand way. Well, Brian, thank you very much for those kind words and the 5-star review. I'd be happy to send you a super soft podcast t-shirt, Brian. Just drop me an email to jesse@bestinterest.blog. And listeners, before we start this AMA episode, as always, if you have questions that I can help answer, especially if they're for a future Ask Me Anything AMA episode, you can send those questions to my email, jesse@bestinterest.blog. Okay, the first question today is from Cedar. Cedar like the tree. Cedar says, I would like to hear more about diversification in a portfolio with examples. For myself, I am retired, I have a pension, I have Social Security and investment income. I don't own any bonds, and I consider my pension and Social Security to be the fixed income portion of my portfolio. Most of the rest is in the S&P 500. So listeners, this is a great and simple, somewhat universal question to start today. And the question really is, does everyone need bonds? And if not, why not? When or why might we need bonds in our portfolio? How do we answer this question for ourselves based on our own circumstances? And then I will go one step further and address what Cedar says at the end of his kind of question/statement, which is that most of the rest of his money is in the S&P 500. To address the bond portion of the question, I want to start off with two important ideas. One, the first is called asset liability matching. It's one of the underpinnings of my financial planning process. And then the second idea is just a more simple and universal idea about the expectations for stocks versus bonds over various time periods. Asset liability matching, I have a really in-depth article that I'm going to link into the show notes that uses real examples with, real ETFs from a real portfolio. The problem is it's kind of hard with all the numbers going on in that portfolio to adequately explain it over podcast, right? It makes more sense for you guys to be able to see it with your eyes. So that's why I think it makes sense to go read that article in the show notes. But in short, okay, the concept of asset liability matching says, in order for me to understand what assets I need to own, I first need to understand what my future liabilities are. Not necessarily liabilities in terms of like debts that you owe someone today, but really it's this idea of what's the liability in terms of what your portfolio needs to do for you in future years. So if you think of a very kind of typical average Joe, average Jane retiree who says, well, I have XYZ going for me, maybe I have some Social Security, maybe I have a pension like Cedar, et cetera, et cetera. But then after all that is said and done, I still need my portfolio to produce $50,000 a year in income for me. That's what I need from my portfolio. That's the living expenses that my financial plan tells me I have. And my portfolio is where that $50,000 per year needs to come from. And if we assume average Joe and average Jane, they just are kind of living the same year like Groundhog Day over and over and over again, we can say, okay, well, $50,000 per year, that's your quote unquote liability. That's the need that we require from your portfolio. And thus, whether it's here in 2025, they need $50,000. 2026, they need $50,000 inflation adjusted. 2027, on and on and on. And I can think about that asset's volatility, and I can think about that asset's expected return when it comes to how much of a particular asset I need to match up to each future liability. For example, if this person needs $50,000 from their portfolio here in 2025, Well, that's a very short timeline. That's a very short timeline to their need. Their need is occurring over these next few months. And therefore, I can't take stock risk over that kind of timeline. I probably need to match something like a money market fund or just a very low duration US Treasury bond to that liability. And if they need $50,000 from their portfolio this year, well, that money should all probably be in very low risk, very short duration bonds. But once I look out to, say, the year 2035 or the year 2045 in their financial plan, and they still need $50,000 from their portfolio in each of those years, well, that's where I say, boy, if I have 10 or 15 or 20 or more years to grow these assets, I can start to take some risk. Maybe I can start to own stocks, even majority stocks for those future liabilities. And if I am owning stocks for that future liability, I don't have to assume zero return like I might with a bond. Yeah. With a bond, I pretty much have to assume that my return is simply going to match inflation, probably not beat inflation. And therefore, each future liability needs to be matched pretty close 1-to-1 in terms of dollars today invested in a bond. Whereas with a liability that's so far out in the future, I can start to invest in stocks. That's where I can say, well, this liability that I have in the year, say 2040, it's 15 years from now. I don't need to match 100% of that liability with stocks today because I assume that my stocks will grow. So maybe I only match that liability, I assume a 6% real rate of return, and I only match that liability with, say, $20,000 today, assuming that the $20,000 is going to grow up to $50,000 by the time I need it in the year 2040. That's the concept of asset liability matching. And going back to Cedar in his question today, I would say, well, Cedar, does your security and your pension, your typical investment income that you mentioned, does that cover 100% of your annual expenditures? If the answer is yes, then your portfolio doesn't have any glaring short-term requirements. All your short-term liabilities are fully covered by the fixed income from Social Security, from your pension, from your investment income. And you might not have any need for bonds at all, right? Because all those short-term liabilities are already covered. Now, that would beg a bigger and more broad question, which is, well, what is your portfolio for then? Is it going to just compound forever and then you leave it to your kids or to charity? Or should you adjust your financial plan such that you actually start spending some of your portfolio on an annual basis, which probably just means living life a little bit more, in which case there will be a short-term requirement for your portfolio, and all of a sudden bonds begin to make sense from an asset liability matching point of view. You're going to have that short-term requirement, those short-term liabilities from your portfolio, and those ought to be matched with a short-term asset like bonds. But now I do want to share a simple idea right now about our expectations for stocks and bonds. It's an idea that certainly can be explained a dozen different ways, but this way in particular, I think is very helpful. And I just want to start with a simple question, which is, what will a diversified stock portfolio return this year, or next year, or the year after that? Now, I think if your answer is anything other than the phrase, I don't know, I think that's a problem. To me, short-term stock returns are absolutely a mysterious black box, kind of like Schrodinger's cat. It's Schrodinger's investment. We just don't know what the returns are going to be over the short term. And therefore, if short-term portfolio returns are vital to your survival, then stocks simply aren't the asset for you. This is a truism, a simple and universal truism of investing. We need a different asset class for the short term. But on the flip side of the coin, if you need your portfolio to last you for decades, then all of a sudden stocks come into focus. We can use the long-term average of stock returns to smooth out any short-term uncertainty. Now, just because we're thinking long-term, it doesn't lead to a guarantee. It doesn't lead to 100% certainty. We can't quite peer through the foggy future that clearly. But it certainly becomes better if we zoom out on stock returns. And by measuring in a zoomed out way, by measuring over decades, we get this really convenient side effect, which is that we start to see the incredible power of compounding. So exactly what do I mean? Well, the basic investor might say that stocks return 10% per year, and bonds return 5% per year, and cash returns 3% per year, or whatever percentage they want to use. But it doesn't really matter because the underlying framework of that is flawed for so many reasons. First, for the reason we already covered, stocks are just too volatile to make any reasonable one-year predictions or averages. And second, such a zoomed-in myopic view overlooks the concept of compounding. Now, one could look at those one-year averages and think, oh, well, bonds return about half of what stocks return. So that's not great, but it's not bad. However, as you'll see in a few seconds, that's also just a very flawed conclusion, because instead, I'd implore long-term investors like us to think for decades and to think not in nominal terms, but instead to consider the undeniable impacts of inflation and taxes. And when we do that, when we think in real inflation-adjusted after-tax returns, and we think about them over decades, we come to the conclusion that for a reasonable 30-year period, I'm focusing on 30-year period right now, we see that stocks will compound our wealth by 300 to 400%, that bonds will compound our real wealth by 0%, and that cash will lose 25 to 50% of our real wealth over that time. Those numbers might surprise you, maybe even shock you. I think that's a good thing. Now, yes, those are actual historical numbers using actual inflation data, actual tax rates, actual investment returns. Stocks compound our real wealth by 300 to 400%. Bonds compound our real wealth by 0%. And then cash loses 25 to 50% of our real wealth. And so we see that bond returns aren't half of stock returns. It's not a fractional difference. They are orders of magnitude different. Now, bonds essentially do nothing over the long run. Cash gets decimated over the long run, whereas stocks show real positive growth. So it isn't really apples and oranges. Instead, it's night and day. And that begs a question. Why should we own any bonds then, right? This gets back to the question that Cedar submitted. Why should he own any bonds? To answer that question, we kind of have to go back to the beginning of this particular little stanza, Quentin Tarantino style, where I said, the simple truth is that I don't know what stocks will return this year. It's just that simple. Stock returns cannot be relied upon in the short or the medium term. And instead, we must use a more dependable, a less volatile asset for those future cash outlays. And then cash or bonds, those are suitable choices for such short-term outlays, and we must accept the lower returns from those assets as the price to pay for their lower risk, for their guarantee. It's a continuation of asset liability matching, that concept we just discussed. However, bonds and cash do not provide long-term growth. Instead, the underlying growth engine of your portfolio has to come from real risk assets, actual risk assets like stocks. To achieve that growth, however, higher volatility is the price that we have to pay. So nothing is free. So I hope that you start to see now that nothing is free. If you need higher growth, there's a cost, and the cost is more volatility. If you need greater stability, there's also a cost there. The cost there is less growth. But that's why we diversify across asset classes. That's why we own both stocks and bonds, real estate, alternatives, etc. if you want them to. They serve different, simple, important purposes. But the big one is different purposes. They serve different purposes. And that's why our measurement period, whether it's months or years or decades, that's why it really matters. So going back to Cedar's original question, if he owns 100% stocks, should he own some bonds? I would think along those lines again. If he has short-term needs, bonds are the answer. If he doesn't, I could understand why he doesn't own any bonds. But last, the idea of having all of his portfolio in the S&P 500, this is the exact same question I answered back in the very first AMA episode 81 of the podcast. So go back and give that a listen, but I'll give you some of the cliff notes right now. And the hypothetical I put out there back in the first AMA, episode 81, was let's imagine it's 1985. I'm living here in Rochester, New York, as I do. I'm close to 100% in Kodak. 100% of my portfolio owns Kodak stock, and it's worked great for me for a long time now. As more time has gone by, I've actually sold out of some of the rest of my portfolio, just gone all in on Kodak, and it's hard for me to see why that isn't a good strategy going forward. Now, that particular example probably sounds crazy. We'd never go 100% into one single company, and of course, I have cherry-picked a company that we now know with the benefit of hindsight went bankrupt. But some of the underlying principles here should ring true. Cedar, you own one single asset class. You have no other diversifying assets. You're all in on the USA. You have no geographic diversification. You're all in on large cap companies, S&P 500. You own just, the 500 biggest companies in the world, which is fine. And it really is. It's far, far, far from the worst asset allocation I've ever seen. I just think it could benefit from some polishing. I think we cannot and we should not say that the recent past has been one specific way, and therefore that the future is going to be that exact same way. That the recent past has been most beneficial for investors in large cap stocks, and therefore the future will also be most beneficial for investors in large cap stocks. It could be that way, but I highly doubt it. And I think first we need to simply accept the fact that we can't predict the future, and that in investing especially, the past does not dictate the future. But more so, Cedar, I want to impart John Bogle's famous iron rule of investing to you, which is reversion to the mean. No asset class can outperform forever. And when an asset class does outperform one decade, it tends to underperform the next decade, reversion to the mean. In the long run, asset classes with a similar risk profile, for example, domestic stocks and international stocks, they have a similar risk profile to one another. In the long run, they also tend to have a similar reward profile, which means that when their reward profiles fall out of sync, when one is just beating up on the other, much in the way that US stocks have beat up on international stocks over the last 15 years, eventually they will tend to revert because they have similar risk profiles. They ought to have similar reward profiles. So in a vacuum, Cedar, my gut tells me that international diversification and small and mid-cap diversification would likely yield some long-term benefits for you. Anyway, thank you very much for the excellent question. Okay, away from investing, now into a deep planning topic. Michelle wrote in for question number 2, and Michelle asks, can you talk about long-term care insurance? What situations call for buying it? When should you avoid it? It seems like there's a cost-benefit analysis that can be done here, along with risk tolerance for self-insuring for your own long-term plan versus buying insurance. So yes, excellent question, Michelle. Let's do a deep dive on long-term care insurance. So long-term care, I'll probably call it LTC throughout this answer here. LTC insurance, well, LTC itself refers to the help you might need when you can no longer perform basic daily tasks on your own. Stuff like bathing, dressing, eating, using the bathroom. To be clear, LTC is not medical care. I think that's something that from the financial, we aren't medical professionals. It might be easy to confuse, but LTC is not medical care. It's not hospital stays. It's not RN nursing. It's human help. LTC is human help. It might come from a home health aide or an assisted living facility or a nursing home. Generally, Medicare does not cover LTC. It does not cover custodial care in nursing homes or assisted living facilities. Now, Medicare might cover some skilled care services in certain situations, like short-term skilled nursing facility after a qualifying hospital stay, because there's an acute medical care need there instead of ongoing non-medical care. But LTC is not medical assistance. It's simply human assistance to help people bathing, dressing, eating, using the bathroom, some of those daily tasks. And the cost of LTC can be pretty jaw-dropping. Now, for home health care, for someone coming into an elderly person's home and helping them there, easily we can see numbers in the $60,000, $70,000, $80,000 per year. Assisted living, again, upper 5 figures per year. Nursing homes can easily get into the 6 figures, $100,000 to $150,000 per year, depending on the location or level of care. Memory care can cost even more than that. Now, the average duration for an LTC stay is 2 to 3 years for men or 3 to 4 years from women. Now, that's average. So some people might need more care than that. So there is a real financial risk here, a risk of needing expensive, prolonged care later in life. If you take those averages, 2 to 3 to 4 years for men or women, and multiply them by the cost per year I just mentioned before, you can easily get $250,000, $500,000 or more for LTC costs. So that's where LTC insurance comes into play. LTC insurance is designed to help pay for those future costs. You pay premiums now, just like you would with other insurance products, and in return, the insurer agrees to cover the future long-term care expenses within some limits, and that sounds pretty smart. And sometimes it is, and sometimes it isn't. Because there are some pretty big problems with LTC insurance. Now, if we rewind back to the early 2000s, LTC insurance was affordable and popular, and insurers were pretty sure they'd found a gold mine. The insurance companies, they needed to make some assumptions, of course, and predictions, of course, in order to properly price their LTC insurance. They needed to answer questions like, how long will people live and how much care will they need? How expensive will that care be? How will the insurance company's float perform in the meantime? And okay, a quick aside, that term float, it is a little bit jargony. So imagine you're running Geico or State Farm. Every month, all of your customers, they send in their monthly premium payments, and that's a lot of money. Now, as the insurance company, you know that a lot of that money that just came in is eventually going to have to go back out to your customers to pay for future insurance claims. But in the meantime, you've got a bunch of their cash on hand. That cash is called float. It's money that the insurance company can quote unquote play with, so to speak, but the money that the company knows that it can't keep forever. And many insurance companies, they choose some typically conservative investment philosophy to earn a little bit of extra return on their float. And float is, in short, one of the unsung keys and probably one of the main drivers of Warren Buffett's long-term success. Berkshire Hathaway is roughly 1/3 of its value is as an insurance company. And you better believe that insurance flow played a huge part in his investment returns over time. But anyway, back to LTC insurance. The LTC insurers underestimated three pretty big things between the early 2000s and today. People are living longer than expected. More people need LTC than they assumed, and it's more expensive than they assumed. And interest rates fell, and they stayed pretty low, hurting the insurers' investment returns, the returns on float over that time. And the result is that insurers simply mispriced the risk of long-term care. So they ended up doing two things. And those two things have occurred kind of over the last 10 years. They've drastically raised the premiums, drastically raised the cost of LTC insurance for people like us, or they've pulled out of the LTC market entirely. And that's why today's LTC insurance policies are more expensive, less generous, and harder to find than they were 20 years ago. It's also why many people who bought policies in the early 2000s feel pretty burned because they bought into a promise and then they saw their premiums skyrocket or they saw their coverage get canceled altogether. So should you buy LTC insurance today? And here's where things get pretty nuanced because essentially, like all insurance, it's a risk transfer decision. You're asking, do I want to pay a known cost, the insurance premiums, to avoid an unknown future cost of long-term care? And here's how I frame it with clients. Who should consider LTC insurance? Well, first, you have to be wealthy enough to afford it, but not wealthy enough to self-insure. So if you have, say, $500,000 to $2.5 million in investable assets, a long-term care event might seriously dent your finances or impact your spouse's well-being. Insurance might be worth exploring. If you're concerned about legacy or spousal care, some people aren't that worried about themselves, but instead they're worried about burdening their spouse or their children. So LTC insurance can provide some peace of mind and some dignity to those cases. The third reason, if you are insurable and in good health. So not everyone qualifies for LTC insurance. The underwriting can be really strict. And you need to pass a health screening, especially if you're over 60. And so you should consider LTC insurance if you're buying in your 50s. Premiums are most reasonable in your 50s. Waiting until your 60s or 70s, not only will it be more expensive, but you're less likely to qualify at all. The question there is, do you want to potentially pay for 3 or 4 decades of insurance premiums for an unknown future payoffs? That's really the trade. That's the transfer of risk. And it's just one of those things where the transfer of the risk is risky in and of itself because it's so far off in the future. So who should avoid LTC insurance? Well, the truly wealthy should. And this is a bit of me pulling a number out of a hat. But if you've got, say, $4 or $5 million or more, and you have no strong desire to preserve assets for your heirs, you can probably just self-insure, right? You can take the cost of LTC, you can take it on the chin, so to speak. You can earmark a portion of your portfolio for those future care costs. You can self-insure. If you're a low-income household, though, if you don't have significant assets, Medicaid will eventually step up and step in to provide long-term care coverage, albeit with limitations on quality and choice. LTC insurance just doesn't make sense here. It's not practical here. And yes, there's an idea I've alluded to before, a semi-controversial practice called Medicaid planning, where people, they think a few years ahead, they intentionally shelter their assets using trusts. And then by doing so, they qualify for Medicaid support, even if otherwise you wouldn't think that they qualify for Medicaid, but by sheltering their assets in such a way, they do. And that's why it's a little bit controversial. And then the third group of people who should avoid LTC insurance, if you're a risk-tolerant DIYer, some people are simply comfortable rolling the dice. They're fine setting aside a pool of money for potential care costs. And they don't really see the need to further risk out to an insurance company. Because buying long-term care insurance is a bet, right? You're betting that the care will be expensive and you're betting that you will need the LTC care to begin with. And the insurer is betting that you won't. So what matters is to understand your risks, to understand if you can afford the premiums, to understand if needing care would drain your spouse or drain your family, and if long-term care and LTC insurance policy would offer some sort of meaningful peace of mind. So thank you for that question, Michelle. Here's a quick ad, and then we'll get back to the show. I still remember it was 2019, and a guy from Fidelity came in to speak to my then employer about personal finance in general and about our 401k plan in particular. There were 60 or so of us who attended, mostly 50 plus years old, clearly with retirement on their minds. And nothing against this individual from Fidelity, but unfortunately, the guy just didn't really know what he was talking about. It ended up being a major disappointment. And a bunch of my colleagues afterwards said, in short, man, we're really thirsty for good financial retirement information. Where do we go find it? Now, does that sound true, listeners, for you and your colleagues? Last year, either in person or via Zoom, I spoke to about 800 employees at 11 different organizations, sometimes about personal finance in general, sometimes about specifics of their retirement plans, sometimes about the nitty-gritty details of Social Security and withdrawal planning and retirement math. The point being, if you're interested in inviting me to come talk money to you, to your colleagues, where you work, that is absolutely something I'm interested in talking to you about. Simply drop me an email to jesse@bestinterest.blog and let's start a conversation. Now, on to question 3. Chris asks for a deep dive on the taxation and the distribution of inheritance assets. So this is something over the coming decades, that topic is going to be more and more important. It's going to affect many of us listening here today. To start, I think it helps that we baseline ourselves with the understanding of how assets can be passed down to heirs in the first place, because there are really only a few options. The first one, via a will, right? A decedent, a person who passes away, they specify in their last will and testament who should receive their assets. Could include cash, investments, property, personal items. Those assets will pass through probate, which is a court-supervised legal process of settling an estate. And the pro is that the decedent gets to direct exactly who gets what. The con is that probate can be a slow process, is a public process, and can be sometimes an expensive process. The second way that we can pass down assets to our heirs is by beneficiary designation. So some assets, they bypass probate entirely. They go directly to a person who is named as a beneficiary. So this includes assets that are in retirement accounts, right? In our IRAs and 401ks, we name a beneficiary. Life insurance policies, transfer on death accounts, payable on death accounts, annuities. These assets transfer automatically upon death to the named beneficiary, regardless of what the will says. So this is a fast and private way of passing down assets. The con would be, though, if beneficiaries aren't updated, outdated designations can cause some very unfortunate and unintended outcomes. A third way that we can pass assets to heirs is through a trust. If a decedent sets up a trust, and we'll get more into trusts in a little bit, then the trust, rather than the person directly, now owns the assets. Upon death, a trust document can act as the instructions for how assets should be distributed. Again, a pro of this is that it avoids probate, it maintains privacy, it maintains control for the decedent on how and when money is distributed. But the con, it's usually significantly more expensive and complex to set up than a will. A fourth way, and not exactly a good way, that assets can pass down to our heirs is by state law or intestacy. If someone dies without a will or a trust, their estate is distributed based on the laws of intestacy in their state of residence. Those laws create some sort of default hierarchy of inheritance. Typically, the spouse is first, the children are next, the parents are after that, the siblings are after that. And then, if those people don't exist, it's cousins and second cousins and third aunts, whatever. The pro, ensures that assets eventually get distributed, but the con is that there's absolutely no control. The money may go to unintended heirs. It can cause family disputes. So this is one that we want to avoid at all costs if we can. And then the last one, although maybe this does belong in the category with beneficiary designation, I just carved it out on its own. It's just joint ownership or joint ownership with rights of survivorship. Essentially, assets held jointly, like a joint bank account or a real estate deed, they pass automatically to the surviving co-owner or a surviving spouse, something like that. Very common with married couples. It can be quite common actually with aging parents who have adult children. Sometimes the adult children will come on as a joint owner of an account or a joint owner of a house because, again, it's simple to do and it avoids probate. However, it's worth consulting with some professionals first because it can lead to some complications or tax issues if not structured carefully. Now, how do each of these different inheritance pathways handle the distribution of assets at the taxation, right? That's the question at hand. So first, let's talk about a will. The distribution of assets occurs according to the directives of the will. It's executed by the named executor of the will. So this might mean something like retitling financial accounts, retitling real estate, or other personal property into the named beneficiaries' names. It could mean selling those assets and or transferring other assets per the will's instructions. Now, for taxation, here's where people get a little nervous. Most of the time, beneficiaries don't owe any sort of taxes on inherited assets. Now, still, there are some exceptions and some nuances. The estate tax is a big one. The estate tax is a tax on the deceased person's estate, not on the beneficiaries. So for 2025, the federal estate tax exemption is around $14 million per person, meaning like 99.8% of estates do not owe it. Some states, though, they do have their own estate or inheritance taxes, but usually at much lower thresholds. So in other words, some states will tax a deceased person at thresholds lower than 14 million. After some quick Googling, I think Oregon has the lowest estate tax with a $1 million threshold before their estate tax kicks in. So if someone dies in Oregon with, say, $3 million, the first $1 million won't be subject to an estate tax, but above that $1 million threshold, it will be subject to an estate tax. And there are 5 states with an inheritance tax: Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. So in those states, it's not the deceased person who gets taxed, it's actually the person who receives the inheritance who gets taxed. Just good to know. Now, as far as the taxes, though, there is a step up in basis for these assets passed through a will, which is important to know about. For appreciated assets like stocks or real estate, beneficiaries, they don't receive assets based on what the decedent paid for them, but instead they receive assets at a basis based on the asset's value at the date of death, which means, in short, that no capital gains tax is owed if they sell those assets immediately upon inheriting them. Now, this is a huge benefit. It essentially wipes away potentially decades of unrealized gains for tax purposes. Now, when assets are passed by beneficiary designation, the second way, so we're moving on past the will, now we're moving to beneficiary designation like IRA accounts or 401k accounts or insurance policies, things look a little different. Now, the most common example that I want to get into today, because it's something that's very likely to affect many of us listening, is that you might inherit an old IRA or an old 401k. You'd been named the beneficiary, and so the question is, how does the distribution and taxation work then? The distribution is fairly straightforward. Typically, the decedent's custodian would set up an inherited IRA account for the beneficiary, and then they would move the proper amount of assets from the decedent's account into the inherited IRA. And from there, the beneficiary or the inheritor is free to transfer the inherited IRA account to their custodian of choice. So, as an example, grandma dies. Grandma has an IRA at Vanguard, naming you as the sole beneficiary. So Vanguard is going to create an inherited IRA account for you. They're going to move grandma's assets into that account, and then you're free to transfer that account to Fidelity or to Schwab or whatever custodian you typically use for your other assets. Now, the bigger question is, how are those assets taxed? The inherited IRA taxation and distribution rules are certainly more confusing than they need to be. Thankfully, they have been simplified in recent years. They're still a little confusing. So what I'm about to describe are the rules and how the rules look moving forward. So first things first, if the beneficiary is a spouse, then that spouse can inherit the IRA and essentially treat it as if it were always their own money all along, full stop. They can make contributions, they can take distributions, they will pay taxes based on their own age, their income, their life expectancy, etc. It's not even really an inherited IRA. It's as if it always was their money all along. But if the beneficiary is not a spouse, if you're inheriting grandma's IRA, that's where things get a little trickier. Thankfully, inherited Roth IRAs are pretty straightforward. Something called the 10-year rule applies. The account must be empty after the 10th year of the decedent's death. So if someone dies here in 2025, they leave you with an inherited IRA. It must be empty by the end of 2035. That's the 10-year rule. And now for a Roth IRA, for an inherited Roth IRA, there are no required minimum distributions, no RMDs, so that's nice. And for 99% of people, unless they really need the money in the inherited Roth IRA, the best advice is just to keep the money there sheltered inside the Roth account, right? It's qualified money, tax sheltered money, until the end of the 10th year, and then withdraw it all at once. There's no tax consequence to doing so because after all, it's a Roth account. Now, inherited traditional IRA accounts are much more nuanced and messy. First, the 10-year rule still applies. The account must be empty after the end of the 10th year after inheriting it. If the decedent, if the person who died, if they were already taking RMDs, those RMDs must continue, but in 2 forms. So in the first year, so let's say here in 2025, because the decedent was still alive on December 31st of 2024, this year's RMD must be based on the decedent's age. And the hard part is they might have already taken the RMD on their own while they were alive before they died. If they didn't, though, then you must take the RMD, or at least your fraction, your portion of the RMD from the inherited IRA. Then, in years 2 through 10, in those years, the RMD will not be based on the decedent's age or what their age would have been if they had survived, but instead the RMD will be based on your age, you, the beneficiary, the inheritor. There's a separate RMD life expectancy table for beneficiaries, And in my opinion, the IRS website, the IRS tables are a pain in the butt to deal with. So instead, I recommend one of many RMD calculators like Schwab's. That's traditional IRAs if the decedent was already taking RMDs. If the decedent was not taking RMDs, then starting here in 2025, the inheritor of the inherited IRA must start taking RMDs based on their own age. And these are traditional IRA dollars. So every withdrawal is a taxable event. It's taxed as income. And that's where we have to ask, like, what's the smart way to think about these withdrawals and the 10-year rule? In some cases, the smart advice would be to divide the withdrawals into 10 even annual chunks. Now, those chunks will more than satisfy the RMD requirements, and it will spread the realized income relatively evenly over the next 10 years. In other cases, though, the smart advice would be to wait on any major withdrawals until some future year. And that advice, to do even chunks versus not to do even chunks, is almost always going to be a function of personal tax rates and retirement plans. If, for example, you're earning, $400,000 for the next couple of years, but then you're retiring in 2027, I would say, wait. Don't take the even chunks. It doesn't make sense for you to realize extra income during these high earning years and pay high taxes, when instead you could simply wait till 2027 when you're in a much lower tax bracket and take a bigger withdrawal from the inherited IRA then and pay much lower taxes. So anyway, I think the takeaway there is that inherited IRAs, a lot of us might inherit one, and they have some pretty funky withdrawal rules, and the strategy, the financial planning strategy around an inherited IRA is just worth thinking about before you just start pulling money out and realizing taxes. But last, for this question, I want to talk about the distribution and the taxation of assets from trusts. Now, in short, I think of trusts kind of like a Baskin-Robbins ice cream store in terms of just the dozens and dozens of different flavors. However, there are some universal basics. I think first, a quick definition would help of the three main players in a trust. In a trust, the grantor, also known as the trustor or the creator, is the person who establishes a trust and the person who transfers assets into the trust. The trustee is an individual or an entity that manages the trust's assets and follows the grantor's instructions in the trust document. And then the beneficiary is an individual or an entity who benefits from the trust, receiving distributions or receiving income, receiving principal according to the trust's terms. So a trust is this kind of living document / living tax entity that we are allowed to set up on our own. And a very common example might be, okay, how about a special needs trust? How about parents say, hey, we have an adult disabled child who we need to be cared for if we were to die. And the way that we're going to do that is the adult child can't necessarily be trusted to handle all these finances on their own. So we are going to create a trust. We are going to move some of our assets into the trust, maybe some now, maybe some upon our death if we die early. So now there are going to be assets that are moved into the trust. A third party, that's the trustee. A third party is going to be named as the person who kind of manages the trust assets, who follows the instructions in the trust document, and who makes sure that the beneficiary of the trust is getting what they need. So in this case, the trustee might be, maybe the trust department of a bank is named. And that trustee's job is to ensure that the wishes outlined in the trust are properly executed, such that the beneficiary, in this case, the adult disabled child, is getting what they need from the trust assets so that they can live a comfortable life, but also that the trust assets are handled very responsibly, not irresponsibly. So again, a grantor creates the trust, a trustee watches over the trust, and a beneficiary is the one who benefits from the trust assets. There are two major categories of trusts, revocable and irrevocable, based on the word revoke. So a revocable trust is created usually during a grantor's lifetime, and the grantor retains control, and they can even amend or revoke the trust if they want. It's revocable. They can revoke it, they can change it, they can even end the trust, they can terminate the trust early. And then assets inside the revocable trust are considered part of the grantor's estate for tax purposes. Usually the main reasons to set up a revocable trust has to do with skipping probate, because upon death, the revocable trust turns irrevocable and those assets can be distributed, skipping out on the probate process. But the grantor maintains control during life, and therefore from a federal and even state taxation point of view, the assets in the trust aren't considered different from the grantor's estate, but are very much considered part of the grantor's estate. But then there's the irrevocable trust, cannot be revoked, cannot be changed. And it really means, with very, very few exceptions, once an irrevocable trust is set up or once assets are put inside of an irrevocable trust, it can't be changed, it can't be revoked, it can't be undone. Assets placed in an irrevocable trust are removed from the grantor's estate, which can offer some pretty powerful estate tax benefits. Typically, these assets are technically gifted into the trust. A gift tax return is filed, and the value of those assets count against someone's lifetime estate exemption. So what exactly does it all mean? I know that's a lot of jargon. So you as an individual, we've already talked about it a couple times today. You as an individual, you have $14 million roughly of federal lifetime estate tax exemption. Imagine someone who maybe they're 60 years old. They just sold a business for $10 million. Now, it might be reasonable that 60-year-old, they could look at the $10 million and it might grow to $20 or $30 million or more before their death. So at age 60, they choose to gift $8 of the $10 million into an irrevocable trust, thereby using $8 million of their lifetime exemption. The lifetime exemption is 14. But once in the trust, the $8 million can grow to 16 or 24 or more, and it's no longer part of their estate. It's now part of the trust, and therefore it's protected from estate taxes. So in other words, in this scenario, in this hypothetical I've outlined, the grantor might be able to pass far more than $14 million onto their heirs through the trust without actually going above and beyond the $14 million lifetime estate tax limit. So this is used for very advanced tax and asset planning. Can be used also just to maintain control of assets after death. Now, how are assets distributed out of trusts? So upon the grantor's death, when the person who put the trust together, when they die, if the trust was revocable, it becomes irrevocable at death, and a successor trustee usually steps in to manage and distribute the assets per the trust's instructions and, avoiding probate in the process. The timing of the distributions can vary. Sometimes it's immediate lump sum. Sometimes there are gradual payouts. It's kind of common to see something like, okay, my beneficiary will get 1/3 at age 25, 1/3 at age 35, and the final third at age 45, something like that. There can be discretionary payments that the trustee gets to decide when and how much is distributed. Different clauses, like I said, Baskin-Robbins, 31 flavors, lots of different ways to write trust documents and distribute those assets. But the taxation of the trust assets is something that I wanted to focus on for today. If the trust was revocable, the assets, as I said, are still counted in the estate of the grantor for federal estate tax purposes. But if they're irrevocable trusts, they're excluded, helping reduce the estate tax exposure. One of the major benefits, that's one of the major benefits of an irrevocable trust in the first place. And we already discussed that many states impose their own estate or inheritance taxes with lower thresholds. So if you think you're flirting with estate tax issues, I cannot recommend enough the power of working with a good team of professionals, specifically a trust and estate attorney and an experienced CFP. And the reason why you want both, I've got a good story from work of a family who, working with a really good and a really competent trust and estate attorney, setting up an irrevocable trust for this family and recommended moving a certain amount of assets into that irrevocable trust. And from the financial planning point of view, we looked at the numbers and we said, actually, this family might need access to those taxable assets here during life. And by putting them into an irrevocable trust, we are limiting their access to their own assets. And sure, we're protecting them from estate taxes in the long run, but we think they're going to spend some of these assets anyway. So because we had insight into the planning side of the conversation, we were able to work side by side with the estate planning attorney and make sure that a very, kind of like a safe and healthy amount of assets was moved into the irrevocable trust, not too much, but also enough to make a real tax impact for this family. But trusts are their own tax entities. They have their own EIN numbers. They have their own tax ID numbers. If a trust earns income like interest or dividends or capital gains, most trusts, they distribute that income annually to beneficiaries, and the income is then taxed to the beneficiary. But some trusts can retain the income, or they can make charitable contributions with the income, and retained income is taxed at the trust's tax rate, which hits its top bracket, 37%, at just over $15,000 of income. So in other words, the income tax brackets that affect trusts are very, very harsh compared to the income tax brackets that affect us as people. So any sort of principal that's distributed out of a trust is usually not taxable to the beneficiaries, but income is, and the recipient will usually receive a K-1 tax document that covers the trust income that they've received. Capital gains are generally taxed to the trust unless they're distributed out to a beneficiary. And there are certain types of capital gains that actually aren't very beneficial to receive inside a trust. For example, if a home is placed into a trust, as an individual, we usually get a very big capital gain exclusion on a home sale. It's $250,000 for an individual or $500,000 for a married couple. But trusts don't automatically qualify for that kind of capital gain exclusion unless specific steps are taken. So long story short, trust taxation is almost always more harsh than the taxation placed on individuals. So that's just another reason why this is something that can be a very beneficial tool, don't get me wrong, but it's something that you want to set up properly. You want to think through pros and cons, possible ramifications. Working with an attorney, working side by side with a CFP is almost always going to be a good idea. So next, question 4 is all about RSUs and ISOs and other forms of equity compensation. I've gotten questions recently from Scott and Mark and a few other people with different and unique questions about these topics. But my thought is I do a little bit of a deep dive here on these different acronyms, RSUs, ISOs, NSOs, ESPPs, some other equity compensation, and then talk about some different kind of mindsets and frameworks to optimize your equity compensation as you receive it. First, I think we need some basic definitions. So let's start with RSUs, restricted stock units. An RSU is a promise from your employer to give you shares of the company at a future date, to give you stock at a future date, typically tied to some vesting schedule, like over 4 years. So when the company comes to you day one and they say, hey, we're giving you RSUs, on that day, you don't own anything. You don't own anything at that day. Once they vest, which like I said, usually might take something like 4 years, you receive actual shares. You receive actual shares of the company. So you no longer own an RSU once it's vested. You own a share of the company, just like you bought it at Fidelity. At vesting, the gift, the shares that are given to you are taxed as ordinary income based on the market value of those shares. So if I'm promised something, I was promised shares in 2021, and now finally it's 2025 and they were given to me. They vest now in 2025, right? They're given to me and I have shares. And I look in my account with the company and as of today, I have $10,000 in shares because of the vesting. Well, that $10,000 will get taxed as if it's ordinary income. But I don't own cash, I own shares. And I'm allowed to sell the shares today for the $10,000 that they were given to me at. And there would be no capital gains taxes associated with that. But if I hold on to the shares and they grow over time, just like with any other stock, as it grows over time after you obtain it, after you buy it, a future sale could trigger a capital gain or a capital loss and a tax consequence associated with that. So that's RSUs. You don't own anything up front. They take time to vest. When they vest, they're taxed as ordinary income. And then if you sell the shares in the future, they might realize capital gains depending on if they grow or not between the time they're vested and the time you sell. Next up are ISOs, incentive stock options. An ISO is an option to buy company stock at a fixed strike price, which is usually lower than the market price. You probably wouldn't exercise the option if it wasn't lower than the market price. And then special IRS rules apply to ISOs that do provide some potential tax advantages. So some of the key points here is that when ISOs are granted or vested to you, there's no tax then. And then if you hold the shares, there's a specific time period here, 2 years from grant, and then 1 year from exercise, you get long-term capital gains treatment of the ISOs. If not, it's what's called a disqualifying disposition, and then it's taxed as ordinary income. So anyway, ISOs are essentially just stock options that allow you to buy a stock at a certain price. And if that price is lower than the market price, then what you can do, you can basically just arbitrage the difference, right? If a certain stock is trading today at $100, but your option allows you to buy it at 60, well, you can buy it at 60, immediately turn around, sell it at 100, and you get the full $40 difference as just profit in your pocket. You just get that arbitrage. But again, depending on the timing from when the options were granted to you, when they were exercised, and when you actually sold the stock, it sometimes can be treated as long-term capital gains. Other times be treated as ordinary income, and it's worth thinking about that ahead of time. Next up are non-qualified stock options, or NSOs, which are very similar to ISOs, but with fewer tax advantages, and therefore they're more flexible for the employers and for your company to give away. The key points again here are that there's no taxing at grant when they're granted to you. When you exercise the NSO, the quote unquote spread, which is that market price minus the strike price, that's taxed as ordinary income. And then later, if you're going to sell the stock, right, that you exercise with the option, if there are any capital gains, you will be subject to capital gains tax. So going back to the same example as before, if your option, let's say it says that you can buy a stock at $50, and then today though it's trading at $100, great. So you decide to buy at 50, the stock's worth 100. That difference right there, the spread, $50 in this case, that spread is immediately taxed to you as ordinary income. But you still own the stock. And so if you want to, you can sell the stock for $100 the same day that you exercise the option. And you can use some of your proceeds there to pay the income tax on the spread. Or you can choose to hold the stock. And then if you eventually sell it, you'll be subject to capital gains, in which case you might have to pay some sort of capital gains tax on top of the income tax that you realized when you exercise the option. The last one that I just want to cover today, because it's pretty common, are employee stock purchase plans, or ESPPs. An ESPP allows employees to buy company stock at a discounted price, often through payroll deductions. Frequently, ESPPs work quarterly, and the way it will often work is that once a quarter, an employee will have the ability to buy their own company stock at a discounted price. Discounts are usually as high as 15%, or can be as high as 15%. And in most cases, that is the discount that I've seen. So basically, the company will either, on the day of that they're offering this deal to you, they'll say, hey, we'll take 15% off the stock price today. Or sometimes there's a look back period where the company will look back over the previous quarter, will find the lowest price in that previous quarter, will knock 15% off that lowest price, will offer the employees the ability to buy stock at that price. The tax treatment for this, it depends. Some ESPPs are qualified, like a 401k would be. Others are non-qualified. And with qualified plans, you get very favorable tax treatment if you hold the shares long enough. Again, which it's that 1 year from purchase or 2 years from grant rule there as well. So again, the whole point is that, or the way that it can be optimized, we'll talk about this in a second in a little more detail. But if an employee wants to, they can use the ESPP to buy discounted shares today, immediately turn around and sell those shares back into the open market. The arbitrage between the discount that the employee receives versus the current market price, it's just extra cash in an employee's pocket. Okay, so let's pivot right now. Defined RSUs and ISOs and NSOs and an ESPP. Are there, though, best practices, quote unquote, for dealing with these various types of equity compensation? I say yes. There are some best practices. There are some rules of thumb that will certainly apply to the majority of people listening to this right now. First, RSUs. The easy but risky mistake to take with RSUs is to let your vested RSUs sit and grow without realizing that they're already fully taxed as income at vesting, and that by letting them sit there, all you're doing really is exposing yourself to concentration risk. Remember, a vested RSU is a stock. And if you just let your company stock sit there and grow and grow and grow, you are exposing yourself to company risk by just over indexing on one single company. So that's why the best practice is usually just to sell immediately upon vesting, or at least to consider doing so. You've already paid the income tax, and holding the stock just exposes you to concentration risk. So if you do hold, I would set a sell trigger, like a price target or a time horizon, to eventually sell those stocks and make sure that you're not exposed to too much concentration risk. It's very typical to see people working for big tech companies getting RSUs every quarter, or having RSUs vest every quarter, something like that, to have this steady cadence of, yes, I just got $50,000 more of RSUs. I'm just going to sell them all. I'm going to take 10,000 of that and put it over on the side in a money market fund because I know there's going to be a tax consequence eventually. But anyway, it's just better than having a concentration risk. It's also worth understanding the withholding that you have set up in your RSU account, as it were. Some companies default to 22%, others default to 37% withholding, which might underestimate or overestimate your real life tax liability. So at the end of the day, thinking of your RSUs, I would think of your RSUs like a bonus, just like a cash bonus that you get at the end of the year, except it's paid in stock. It's not paid in cash. But what's not right, or what I wouldn't recommend, is to think of your RSUs like lotto tickets, right? Like stock lotto tickets that might hit the moon. I think that's just exposing your financial plan to too much risk. ISOs offer interesting tax treatment, but they come with real complexity, especially around something called AMT exposure. AMT is the alternative minimum tax. So the best practice for ISOs is to understand the two holding periods that we talked about here, the 1 year from exercise and the 2 years from grant, that help qualify ISOs for long-term capital gains treatment. And before exercising large amounts of ISOs, it's worth sitting down with a professional to run some sort of AMT, alternative minimum tax projection, because unexpected AMT bills are one of the bigger regrets that come with exercising ISOs. So if possible, if allowed, you can consider early exercise of those ISOs to start your holding period when the value is low. You can also exercise gradually over time, especially when the spread between the strike price and the stock price is small. And then it's also worth understanding, and this is true not just for ISOs and RSUs, but really for any of these things we're talking about today. It's worth understanding that if you were to leave your company, what were to happen to that equity compensation. ISOs, for example, expire 90 days after separation with your employer, so it's worth planning ahead on that front. Next, NSOs. What is the best thinking on NSOs? The best thinking here is pretty straightforward, but it's relatively tax heavy. It's to know your strike price and know the fair market value, and just to know that the difference between those is taxed at ordinary income rates. If you have reason to believe the stock will rise long term, the best thing to do is probably to consider exercising your options as early as possible so that you can start the capital gains clock. You can reduce the ordinary income tax you would owe and instead increase the capital gains tax that you would know. It's important for NSOs to monitor expiration dates. They often lapse 10 years from grant or, again, 90 days after leaving a company. It's worth knowing that NSOs, they don't trigger the alternative minimum tax, but they can push you into higher tax brackets at exercise. So again, this really is, it's more than just a portfolio conversation. It's also a tax planning conversation. And then last, let's talk on the best practices of the ESPP plan. It's definitely worth participating. If your company offers a discount, especially with that look back feature, it is definitely worth participating. I would recommend selling immediately after shares are purchased, though, essentially flipping the shares so that you can lock in the discount with very minimal concentration risk. If you want to hold some of your company shares for the long run, I understand that. It's just, again, you need to understand the qualifying disposition rules, as it were, so that you can get the best capital gain treatment, the long-term capital gains treatment, if and when you end up selling those ESPP shares. And then it's definitely worth setting up an automated contributions if your plans allows you to do so. Just straight out of the payroll deduction makes it pretty seamless to set up. ESPPs, in summary, I would think of them as another form of free money, just like a 401k match. And if your company has an ESPP, definitely look to take advantage of it. So some universal best practices for all of these different types of equity compensation that we talked about. The first one is simply to diversify. Don't let your employer's stock become, the majority or even a plurality of your net worth, especially when your paycheck depends on that company as well. Number two is to create some sort of sell plan. You need to set rules in advance about how much of your equity compensation you'll sell, when you'll do it, why you'll do it. We want to remove emotion from this sort of decision making. The third important rule is just to track important dates, to know your grant dates and your vesting schedule and your expiration dates and holding periods. Sometimes your employer will use some sort of broker that will keep this really nice and organized for you. But other times I've seen statements where it's really hard to decipher what's going on, and it might be worth keeping your own sort of spreadsheet somehow so that you understand all these dates. Fourth, it's definitely worth working with some sort of tax pro or tax planning pro. As we've already talked about, equity compensation can trigger interesting, different, surprising tax bills. So a CPA or a financial planner with lots of equity experience can help project your tax liability, help you understand your AMT exposure, can do some year-end planning, gifting, donor advised funds, those kind of things. There's a couple CFPs I work with here with a lot of experience on that. And that's a big part of what they do with our clients, is ensuring that they're getting the most out of their equity compensation. And fifth, I would just think about coordinating with your goals. This is a general financial planning rule anyway, but your decisions about exercising or selling should tie back to your goals of buying a home or retiring early or funding college or whatever it might be, right? These different things in financial planning, they all interact with one another.
Here's a quick ad, and then we'll get back to the show. Serious question. Why do podcasters constantly ask for ratings and reviews? Yes, they do help highlight our shows to new listeners. They help strangers find us on Apple Podcasts and Spotify. It's totally true and a good reason to ask for ratings and reviews. But I have something more important, at least more important to me. I want to know if you like this stuff. I want to know if you like my podcast episodes, my monologues, my guests, the the information I share with you and the stories I tell. I want to improve and make your listening more enjoyable in the process. So yeah, I would love to read your reviews. And sure, if you throw a rating in there too, that's great. If you like what I'm doing, please share it with me. It's such a great feeling to read your feedback. I'd love to read your review or see a rating on Apple Podcasts or Spotify. Thank you.
And now on to question 5. Mike wrote in about having money on the sidelines and is now the right time to buy in. So he says, we're a late 30s couple with 2 young kids and 2 good careers. We're saving through many different avenues, 401k, 529s, etc. We also have about $800,000 currently in a taxable brokerage account. Of that $800,000, about $200,000 is currently sitting in a money market fund. I made that choice a couple years ago when the markets were choppy, and I have maintained it ever since. The 4% interest rate is pretty good. But I also wonder if I'm missing out on something better. For reference, the other $600,000 in the taxable account is all invested in stocks. Interesting question, and it's certainly a common question right now as I'm recording this on July 14th. Markets are basically at all-time highs, and so with people with cash on the sideline are asking themselves, is the market going to come back down, or have I simply missed out on an opportunity over the past couple of years? So the question that I would always pose to someone in this situation is, why are you holding on to the $200,000 in cash in the first place? Why are you holding the cash in the first place? Whether it's $200,000, $2 million, or $20, why is that cash sitting in cash? Now, there are a bunch of really good possible answers. Maybe it's acting as part of a family emergency fund, providing, X months worth of living expenses. If you spend $15,000 a month, this $200K represents 1 year of safety net cash. And Mike mentioned, so both he and his spouse are high achievers with specific career goals. It might take them some time during any future job search, should they need to take that time. And for that reason, it might make sense for them to have a bigger than typical emergency fund. It might make sense for them to have more than just, say, 6 months of expenses. And that's a pretty unique thing that I don't think many people think about. I'm going to pick on, say, nurses here, for example, because I know some people who are nurses. Most of the people I know who are nurses, if they were to lose their job, they could very quickly find a different job as a nurse. They're in high demand. A lot of nursing jobs are reasonably similar to one another. And therefore, 6 months for an emergency fund makes sense for them. But if you have a very specific set of skills, or if you have kind of built your career to such a place where you'd really want to take your time finding a new job, that there aren't many jobs out there that could really light your fire, and you want to really scour the entire country to find the right one, 6 months might not be enough time for you to do that. And therefore, you might want to lean more towards, say, a 12-month emergency fund. So anyway, that's a perfectly good reason for Mike to have this much cash. A second perfectly good reason is that he's expecting some really large spending out over the next, say, 24 months, and he wants to keep that future outlay sitting in cash. Maybe he's redoing his roof next summer. Maybe he's buying a boat next summer. Well, whatever money is going to be required for those outlays, that should be in cash. That shouldn't be in the stock market. And a third perfectly viable reason is that maybe he just doesn't want the risk associated with owning 100% stocks in that taxable account, and holding a meaningful money market position acts as some sort of ballast against the volatility of stocks. That's fine. We want anyone's portfolio to accomplish 2 important things. It's got to grow enough during bull markets so that it can meet their long-term goals, and it has to be stable enough during bear markets that they don't totally freak out. Now, those 2 statements, that's true for any and all investors, including all of you listening today. It's a good reason why 2 similar investors, or at least similar on the outside, they might have very different looking portfolios. Our portfolio, it needs to grow enough during the bull markets so that it can meet our long-term goals, but it has to be stable enough during the bear markets such that we don't totally freak out. That second one especially, how stable is too stable, or I guess I should say is how stable is not stable enough. At what point do we start freaking out due to lack of stability? That's going to look a little bit different for everybody. So going back to Mike, the $200,000 he has, or the 25% of his taxable account in a money market fund, it's definitely going to dampen his upside potential, but it's also going to dampen his downside risk. That's a trade-off, totally reasonable trade-off. And if that's his reasoning for holding this cash, that's totally okay. But the main reason to not hold money in that taxable account is to think, well, the market's been acting weird over the past 1 or 3 months or 6 months or 24 months. Tariffs have me worried. The market's overvalued. I just want to hold some money until the market figures itself out. I want to hold some cash until the market figures itself out. That's not a good reason to hold cash in your taxable account, because the simple and harsh truth is that the market has always had weird behavior to it. You can read accounts from 100 years ago, from 50 years ago, from 20 years ago, anytime in the past, and you'll find people, including really smart people, who thought that those times were weird. And sometimes those people, they chose to hold on to cash, to wait for the weirdness to be over, and it's really hard to get that timing perfectly right. Most investors make really big mistakes right here, doing exactly this, and that's what we want to avoid. Peter Lynch has the perfect quote to describe it. He said, "More money has been lost trying to anticipate bear markets than has been lost in the bear markets themselves." As investors, we are much better off saying, I don't know exactly when this weirdness will end, and maybe a new type of weirdness will start, but I'm going to slowly invest my money over time anyway. And it's ironic because we're all doing that in our 401k accounts anyway, right? We're all investing money slowly over time. We're adding every 2 weeks, rain or shine. And meanwhile, sometimes we're doing that with, out of our right pocket, we're investing every 2 weeks. When in our left pocket, we say, well, everything's weird. I think I'm going to hold on to cash. So anyway, if that's the reason why Mike or any of you are holding on to cash in your account, I would recommend the following. On the first day of every month, take a certain amount of money, a pretty meaningful percentage. Maybe for Mike, it's $10,000 or $15,000 or $20,000 from the money market assets and invest it into a diversified manner into the stock market or into the rest of the portfolio. If you can dial that 10K or 15K or 20K higher, go ahead. But the goal is that over the next 6 or 12 or 24 months, that we trickle all of that cash back into investable assets. It's pretty simple. It's hard to time the market. By holding on to cash intentionally because of our market concerns, we are timing the market. I've had great conversations with clients and listeners, and I can think of some from the tariff tantrum in April 2025 of all those tariff and related fears, whether it made sense to time the market at that point, whether it made sense to put more money in or take more money out or just do something drastic. We're currently up 23% as I'm recording this. We're up 23% from the April lows. We're currently at all-time highs. I had another great conversation with a listener last August when we were at an all-time high, and they had similar fears about the market being overvalued. Well, we're up 11% since that conversation. I spoke with a woman recently who shared with me some timing mistakes she made during the early days of COVID, when it really seemed like society would be thrown off course for years. And on that axis about society being thrown off course, she actually might have been right. But it certainly didn't affect the market the way that she expected. And I think the thing that's funny about all these stories is that half the time it feels like people are really scared by the market's enthusiasm. They see the market as overvalued, as too frothy, and they want to hold their cash. They want to hold on to cash, I should say, while waiting for the market to crash and to calm down. But the other half the time, people are scared by the market's pessimism. They're scared by real world turmoil, and they see the market as having no potential future growth. And yet, time and time again, both of these groups of people are more often wrong than right. And the magnitude of their mistakes is greater than the magnitude of their successes. At the end of the day, it's really hard to time the market. It's really hard to predict the future of the world. It's really hard to predict how the market will react to the future of the world. And the best thing we can do is just slowly dollar cost average in over time and let the market do its thing. And now on to the last question for today from Paul. Paul wrote in and said, Jesse, I'm years away from RMDs, but all the bad stuff that comes with them makes me worry. I'm forced to withdraw more than I need. My withdrawal rates start too high. They just keep going up. It triggers higher taxation of Social Security. It increases my IRMA Medicare surcharges. No more stretch provision for heirs. I'm going to skip over that one because it has to do with inherited IRAs. But a particular fear is the self-inflicted sequence of returns damage. I rebalanced my portfolio in May. As part of that, I figured that's when I'll take my RMD. Let's say my IRA balance was $1 million as of December 31st. However, the market drops 30% in February and it has not recovered. I'm now forced to calculate my RMD against an account balance that doesn't even exist anymore. My balance is down to $700K, but I have to calculate my RMD against the $1 million as of December 31st. Conceivably, this could happen many times over 20 plus years. The RMD might force me to withdraw 5 or 6% or more of my account when, if I were in control, a guardrail approach might only suggest 2% withdrawals for that year. Basically, when there's a hole in the boat, best not to make it any bigger. I find this scenario very troubling. So Paul outlines a fascinating and possibly scary concern here, listeners. And the question is, do required minimum distributions, RMDs, have a destructive synergy with the sequence of returns risk? And can this combination really sink your boat? So let's dive in. I'll add some color and explanation to Paul's question. I'll walk you through my thoughts and ultimately leave you with a solid plan of how to mitigate or even avoid these bad outcomes in your retirement. So some basics to provide background on Paul's question, just to make sure you can fully understand what he's asking. Required minimum distributions, or RMDs, are mandatory withdrawals you must take each year from certain tax-deferred retirement accounts like traditional IRAs and 401ks. RMDs start at age 73 or age 75, depending on your birth year, possibly at other ages in the future, depending on future legislation. Your RMD amount is based on your account balance and remaining life expectancy. Just like other withdrawals from tax-deferred accounts, RMDs are taxed as ordinary income. Now, the sequence of returns risk, another important thing to define, states that not only do the magnitude of your investment returns matter, but the sequence of those returns matters as well. More specifically, if we see a particularly poor series of investment returns during the early years of retirement, it can permanently damage and permanently derail a long-term retirement plan. So Paul, who asked the question, outlines a couple other scenarios too. I'll explain them here, but won't dive much deeper. He talks about higher taxation on Social Security. Depending on your total income, only a portion of your Social Security is actually taxable. Now, granted, those income brackets are relatively low. So for example, a married couple earning $44,000 or more per year, which isn't very high for a married couple in retirement, $44,000 per year. But if they're earning $44,000 per year or more, then the full amount, the maximum amount, I should say, of their Social Security is taxable. The maximum amount is 85%. And now it is worth noting, this is a side note to a side note, that having 85% taxability on your Social Security is much different than saying it's taxed at an 85% rate. Instead, it means, really what it means is that 15% of this couple's Social Security income is totally tax-free, while the other 85% is taxed at one of the federal income tax rates, 10%, 12%, 22%, something like that. So the whole point is, if you earn too much money, more of your Social Security will be taxed. However, the thresholds there are pretty low, and I would say most retirees who I've encountered, the maximum amount of 85% of their Social Security is subject to income tax. The next thing that Paul was worried about are IRMA surcharges. So, right, the income-related monthly adjustment amount, IRMA, it's a Medicare premium surcharge imposed on higher income Medicare beneficiaries, in addition to the standard Part B and standard Part D premiums they're already paying. The amount of IRMA surcharge that someone pays is based on their modified adjusted gross income. And in short, the more money you earn in retirement, the more you will pay for Medicare. Paul also mentioned no more stretch provision for heirs. So in short, the withdrawal rules for inherited IRAs used to be very beneficial for heirs, allowing them to keep large amounts of money growing in their tax-deferred accounts for decades and decades and decades. Now, however, and they called it the stretch rule, but now the 10-year rule mandates that inherited IRAs must be emptied after 10 years. There's no more stretching the withdrawals out for decades. So for both the Social Security and IRMA concerns, RMDs can be negative. RMDs can lead to higher Social Security taxability and result in higher tax rates on that Social Security income. RMDs can also certainly result in higher IRMA surcharges. All of those things are possible. But this is where, forethought in your financial plan can pay some huge dividends. It won't always be possible to avoid extra taxes and surcharges, but a prudent plan certainly thinks about these questions ahead of time. I want to focus the remainder of this answer, though, on Paul's primary concerns, which is, can RMDs combine with sequence of returns risk to really torpedo your retirement, all completely out of your control? Now, I do think it's important we understand how these things interact, but with proper planning, I think we can turn this perfect storm, as it were, into just a passing rain shower. And there are a few reasons why. The first reason, a sequence of returns risk exists with or without RMDs. The sequence of returns risk, it's omnipresent for stock market investors, whether they're taking RMDs or not. The three principal ingredients that can turn the sequence of returns risk into a real danger is 1, your withdrawal rate, 2, the returns from the market, and 3, where you are in your kind of retirement withdrawal timeline, earlier being worse for you. Earlier is worse than later. And it's kind of like a fire, or really like an explosion. It requires fuel and oxygen and a spark. And if you're missing one of those key components, you won't really get an explosion. To that end, RMDs only make the sequence of returns risk worse if the RMD is increasing your overall withdrawal rate. For some retirees, their RMD will do just that, at least a little bit. But for many retirees, RMDs might not actually increase their withdrawal rate at all. Instead, RMDs will simply shift which account they're taking most of their withdrawals from. The second reason I don't think Paul's concern is that big of a risk is that the sequence of return risk is usually pretty well dissipated by the time RMDs come around. There's some really good charts out there that cover kind of how a certain sequence of returns will affect a retiree at given points during their retirement. And any way you cut the cake, the earlier, the worse, right? So the earlier a poor sequence of return strikes, the worse it is for the investor. And by the time someone is 73 or 75 years old, and at that point of their retirement, the sequence of returns risk simply isn't that bad at that point, especially if the earlier years of their retirement had positive returns. Their portfolio is in such a healthy place that a sequence of poor returns at that age, at age 75, simply doesn't matter that much anymore. A third reason that maybe is just the biggest reason today is that asset allocation helps everyone. So whether you're at RMD age or not, proper asset allocation plays a pivotal role in mitigating the sequence of returns risk. Our short-term needs, as we talked about multiple times in this episode, our short-term needs should be met with low-risk assets, and that in and of itself will mitigate the sequence of returns risk from kind of rearing its head in your life. Fourth, Roth conversions can be a massive help here. I've talked at length about Roth conversions. I highly recommend you read up on some of my work on Roth conversions, and they play a significant role in mitigating the risk of sequence of returns risk plus RMDs, simply because for every dollar that you convert to a Roth account, it becomes one less dollar that will be subject to a future RMD. It'll be one less dollar that's subject to a quote unquote forced withdrawal. The key, though, is that you've got to start many years before your RMD age hits. I've got an email in my inbox, my blog inbox right now, waiting for me, of an individual who's facing down massive RMDs starting next year, and he's asking me for kind of Roth conversion help. And I'm not sure what the previous 10 or 15 years of this individual's life looked like. All I know is that at this point, with RMDs 1 year in the future, there's not a lot we can do on the Roth conversion front. So one thing that is interesting, though, is that even if your Roth conversion yields zero tax benefit, which at the end of the day, the main benefit of Roth conversions is tax arbitrage, but you can have a situation where you have zero tax arbitrage, but you can still choose to execute the Roth conversion anyway because it will move those dollars away from the RMD crosshairs. There's still that benefit there. And I should say Roth conversions can also be an excellent tool for planning around IRMA surcharges. The fifth reason why I think Paul's concern is a little bit overstated is that in his original question, Paul mentions his plan to take RMDs in May because that's when he performs his annual rebalancing. And that's a choice. That's Paul's choice. That's not a rule. And that particular choice does magnify Paul's specific risk. I would recommend instead that Paul consider spacing out his IRA withdrawals over the year, perhaps monthly, perhaps quarterly. We can think of it as dollar cost averaging out of his account, diversifying through time, I've heard it referred to. By diversifying that way, we decrease our exposure to sudden market events. Or Paul can just take the RMD in early January. If the risk of RMDs plus sequence of returns is really sticking in your craw, I think that we can just take the RMD as early as possible because, as we already covered, your RMD is calculated based on the IRA value as of December 31st of the prior year. Well, let's not even give the market a chance to crash. Just take the RMD right away in early January, and you know that the RMD you take will be based essentially on the same exact account value where the RMD amount was calculated against. And then my last thing to keep in mind today is simply to stay invested. There's no reason why you can't take your RMD, withhold whatever taxes need to be withheld, and then take the remainder and immediately reinvest that money inside of a taxable account. In fact, you can even, in many brokerages and many custodians, you can take your RMD in kind. You can just pull the shares out of your IRA. You don't even have to sell the shares. You can just move them in kind into your taxable account, and then you would just owe the taxes based on the size of that withdrawal. And that way you stay invested because the sequence of returns risk, it really applies to a situation where you withdraw money forever. You sell the stocks and you keep it sold. You spend the money, you deplete your investable assets by 4 or 5 or 6% in the middle of a down market. But with RMDs, I mean, yes, you might have to take 4 or 5 or 6% out of your traditional tax-deferred assets, but that money doesn't just disappear. You can go out and just buy stocks or buy whatever assets you held inside of a taxable account. You might have to set aside 10 or 20 or 30% of the total for the federal and state taxes, but the remainder can be and probably should be reinvested. So in conclusion, I think it's really good for Paul to think this far ahead because probably, 99% of retirees would not have the foresight to think of this question. However, I do think if we apply some of the tactics and strategies I've outlined here, the true impact of RMDs plus sequence risk is probably going to be more negligible than we think. So listeners, thank you so much for submitting your great AMA questions. And I'm already taking questions for AMAs number 9 and 10. Feel free to write into jesse@bestinterest.blog. Thank you for listening.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.